So why don't we just start this off? I'm going to start off with a question that I asked the accelerator guys, and that is, Gil, we know you already, so we can skip you, but before starting or joining your current venture fund, what did you do immediately prior, and what was your worst job that you've ever had?
Before starting Homebrew, my job immediately prior was VP of Product at Twitter. My worst job ever, I worked at a miniature golf place where I was responsible for cleaning the restrooms. And it was not limited to just the men's restrooms. So it was often a very unpleasant experience.
Which were dirtier?
I'll let your mind wander, but you can guess.
So my name is Boris Wertz. Before starting to be an investor, first an angel investor, then a VC, I was an entrepreneur, sold my company to Amazon. I think the worst job was probably, being a founder sometimes. It was some of the hardest experiences. I'm probably not the guy that cries a lot, but there were moments I cried.
I'm Miura-Ko. What I was doing prior to joining or founding Floodgate, I was working at PhD at Stanford. And my worst job was in high school. I worked at a senior citizens home where I had to do whatever I was told. And one day, the day I quit was the day an old lady asked me to dig a bush up. And I had basically a small shovel about this big.
Dig a bush up. Interesting. All right. Well, let's go down the line and maybe let's stick with you and start with you. Tell us a little bit about Floodgate's investing thesis. What do you guys invest in, and what's maybe a typical or representative investment?
Yeah, so our thesis is that there's approximately 15 plus or minus 5 legendary companies. My partner Mike calls them thunder lizards in any given year. And our basic thesis is that we want our unfair share of them. And so hopefully 100%, but if we can't get 100%, as many as possible. We're a small fund though, we're $75 million, and so we have to spot them a lot earlier than everyone else can. And so it's really about trying to figure out which companies, whether they're consumer or enterprise, are going to end up as one of the top 15. And our investment sizes have ranged from $500,000 to $3 million.
You used to have a clever name for those types of companies.
Thunder lizards.
Thunder lizards.
Inspired by Godzilla.
All right, awesome. Boris.
So version 1 is a $20 million fund. We invest across North America in SaaS companies, marketplace and platforms, and e-commerce companies. Usually checks out between $250,000 and $500,000 in both seed and Series A. Probably some of the more notable investments are Indigo and Flurry.
Homebrew is a $35 million seed stage fund. We sit at the intersection of a focused investment strategy and an investment thesis. The focused investment strategy means we try to do a relatively small number of investments each year, kind of 8 to 10, with the idea that we're the investor of record. We try to write the big check, roll up our sleeves, and take homework from the companies to help them build the businesses they envision. And the thematic focus is what we call the bottom-up economy, but it stems from our personal experiences helping to build AdSense and YouTube and Twitter, the products my partner and I worked on. And it's really based on the idea that technology is helping to level the playing field between the big guy and the little guy. So everything we invest in is focused on individuals, small businesses, and developers, and helping them get closer in some way to information technology or revenue. And our check sizes range from $500,000 to $1 million.
So one of the luxuries of not having LPs is that you don't have to explain to them what you plan to do with the money. So my main fund, the check size of $200,000 to $3.9 million per deal. We basically do mainly consumer, although we're willing to look at almost anything. I then worked with a couple partners who were here earlier to launch a SaaS fund that is very specifically focused on software as a service, recurring revenue businesses. The SaaS fund is now the 6th largest syndicate on AngelList at about $1.1 million. check size, and that's all we do. And last week I launched the Internet of Things Fund that's going to target hardware and software, which is of course all the new rage now after Nest and Dropcam and Apple's amazing work. And so we're going to have a separate fund that just looks at hardware-software combination. So that's a really long-winded answer, sorry.
So Gil's looking to monopolize the AngelList Syndicate thing just by launching all these. So it's like a land grab now. You're just saying, oh, we're going to do the Internet of Things Fund. And
if you talk to the cereal guys, they tell you we don't want to have the best-selling cereal on the shelf. We want to have the whole shelf. So we're launching a series of vertical funds. We're going to do some stage-specific funds, like actually talking about, because again, we're not beholden to an LP that says, well, that's not what you told me you were going to invest in. So I can put $4 million into a D round, and that's okay, which is weird for an angel fund.
Yeah. Did you mention on the last panel a couple representative investments you've made already?
No, I suck at this. LinkedIn, PayPal, Evite, more recently Indiegogo as well, which is doing quite well, Wealthfront, and a number of others.
But from your syndicate, sorry to focus on this.
Sorry, the syndicate is actually closing right now for DataNize, which is a big data as a service company. We invested in UXPin, which is a SaaS business for design and UX. As well as a couple of really nice ones, Old School, which Founders Fund, and Andreessen led an A in, and OnBeat, which is in the process of actually closing an A. Shh, don't tell anyone.
Any journalists here? Bunch registered. Good stuff. Let's continue. So part of the theme of this entire event is just the dynamic changing face of early stage funding, and picked a couple new and emerging up-and-coming seed funds in the syndicate. Satya, maybe let's start with you. How do you differentiate Homebrew versus maybe the old guard of funds? And let's maybe take an example. Let's take a hot deal. How do you almost pitch the entrepreneurs as your differentiation?
I think the approach we take is not to try to pitch the entrepreneurs. The approach we take is we spend a lot of time working with the entrepreneurs through the diligence process to help them understand what it would be like working with us, and for us, what it would be like working with them. So the way we differentiate is we approach it like a product. We're product managers by background, and so we really think of everything as establishing product market fit, and every opportunity to work with a team is trying to establish product market fit with that team. So in addition to kind of our thematic focus and the notion that we want to be the investor of record at the seed round, aside from our brethren here, there are probably very few investors at the seed stage that are willing to write the first check and the big check. Lots of people want to follow on and wait to find a lead. We're happy to be the lead, pre-product, and then roll up our sleeves and be helpful. So for us, this is a very long-term game, and we're trying to build relationships. And for some people, that matters a lot, and those are the types of people we want to work with.
Boris, I'd love to hear from both of you. What's your...
Yeah, I think we always think around it when we invest. We want to be kind of the most helpful, most active investor in the first 18 to 24 months from the moment we invest in, and kind of get them to the next stage, if that is Series A or Series B. I think in the end it really comes down to a few things. You work really hard for the startups. You're a great partner in good and bad times, right? And you try to give them the best advice. And we're always, for me personally, I can draw on my own experience as an entrepreneur and having started and scaled and sold a company, and that certainly helps me most of the times to give really great advice, hopefully to the entrepreneurs.
Do you have a partner, or?
I have an associate, so a team, but not a partner.
And for me, I've been investing since 2008, and so between my partner and I think we both have entrepreneurs who are really good at that for us, and so that's become our brand. So I've been, I was the lead board member, early investor in companies like Lyft, TaskRabbit, LawnClock, Winilo, on the enterprise side, AOSD, Xamarin, and a lot of these companies had near-death experiences. Lyft was Zimrine for 2 years, and so what I found is that just having our entrepreneurs say, look, this is the person who, like Boris is saying, sticks by you when it's not really hot, right? And no one else sees it. And people are saying, why in the world would you invest in it? That's when we're there. I think those stories are most powerful, and we also believe, rolling up our sleeves and being active investors is very important.
Cool. We structured tonight's agenda almost in a chronology of what a startup might do to raise funds. Go through the accelerators, get on the online platforms, and then come to VCs. So let's kind of reverse engineer that as the VCs. Are you looking at AngelList, Circle Up, Funders Club? Are you looking at? I assume you go to the demo days at Y Combinator and Techstars pretty regularly. Are you getting deal source from those channels? And if so, what's maybe the most attractive channel?
I think personally they're all interesting sources of deal flow, and you look at all of them. I think in general, as an investor, you're going to be most successful if you ahead of the curve, if you find a startup that nobody else looks at. I mean, by definition, there's 500 investors looking at the YC startup at demo day, and there's thousands of investors looking at AngelList startups, right? So I'm not saying that you would never do that deal, but in general, being ahead of the curve, being different than what everybody thinks is important. When you look at Indiegogo pitched, Slava pitched 80 people, 80 VCs, and got turned down 80 times, right? We wrote one of the first checks into it and committed to it. But these are the things where you commit to something before anybody had talked about crowdfunding. You commit to a company that becomes a category leader, right? And often these things go to zero because they don't work out, and sometimes you get really big home runs. But I just don't think that going after the masses and what is hot is makes you successful as an investor.
It's funny you say that. I worked with Kickstarter before they had an E. That's like my claim to fame. When they had to buy that name, and they pitched a lot of VCs. No one understood that model at all, right? And now obviously it's everyone would love to have a deal. It's interesting. So okay, well, Satya, how are you finding deal flow? And are you using the channels that we've heard about today?
Sure, I think we publish a lot about how we think about these things, and we've written some blog posts on this. At this point, about 2/3 of our deal flow comes from entrepreneurs and executives that we know through our prior experiences. As far as the accelerators go, because we are relationship focused, we tend to not be excited about teams we meet on demo day. We like to meet teams before demo day and build a relationship with them. And probably about 25% of our deal flow comes from other investors, accelerators, angels, those kinds of folks. So those two are the biggest sources of deal flow for us.
Am I the only one who has never been to demo day? You guys been to YC demo day?
The early days.
Early days, okay. Well, two of us haven't, I guess. I would agree, right? Like, by the point the startup's out fundraising, doing the demo, it's too late. Most of the people here, myself included, get deals because we know people or people trust us. A couple things that we do to try to differentiate. Again, not being a VC fund with conservative pension funds as our LPs, we can do things like we don't need a board seat and no one needs to take a board seat. Or we're willing to give the founder more control. I'm actually just closing up a deal right now where the founder's insisting on what all of my VC friends say is an insane level of control. To which my answer is awesome. That's going to be great marketing for me. I'm in.
I think for me, the issue I've had with a lot of the demo day startups is that they'll say, they'll come in, they'll pitch, and they'll say, you have 24 hours to decide. Send me your $1 million check by midnight, and you're in. And to me, that questions sort of even what they're in it for, right? It's like going to, I don't know, when they have like those bachelor auctions and the guy walks up and he like takes off his shirt, he says a few things about himself, and then you're supposed to like decide if you want to marry him. And to me, that's not the basis for a relationship. And so, what I prefer is long-standing, sort of what we've all talked about, these relationships that we're building. For me, I feel like the unique deal flow does come from the people that we know, and again, the entrepreneurs we've developed relationships with. The other half for me has also been outside of my consumer space on the enterprise. A lot of it is built on technical insights that I'm really interested in. So a lot of those are PhD students and professors that I actually know. In my PhD, a lot of my classmates actually went off to be professors at other universities, and so I'm getting sent, papers, literally that no business plan papers, and I can sort of read through them and figure out if there's an interesting technical insight that could potentially turn into a product. And I've already taken a couple companies through that, and so there again, sort of, it's where no one else is hunting, right? And so to me, that's exciting, that's interesting.
But,
I would just say one thing in support of Ash, who was on earlier from AngelList, and it just occurred to me, these are all, to be clear, incredible people who do really great work and help startups, but I'll say the disruptive comment anyway, which is the comments you're hearing from all of us about relationships mattering kind of remind me of the way politics was 50 years ago when relationships decided who ran for Congress and Senate, and there were backroom deals for who got elected. And AngelList is in many ways democratizing this fundraising and making it much more like The Bachelor. And that's great for entrepreneurs and not so good for people who need relationships to get deals.
Yeah, I was just going to comment on that because it sounds like much of the deal source is the traditional relationship network and not as much of these new platforms which often market themselves as a vehicle, right? As a way to fast track that relationship. Okay, well, anyone have any tips, for getting in front of you if you don't have a long-standing relationship or didn't go to Stanford or, criteria maybe? If it's not through the accelerators and it's not necessarily just by listing on AngelList, is there any?
I think the most important thing is do something unique, do something interesting, right? I think my biggest complaint always of entrepreneurs is that you have another social things that you've seen X times. You just, as an investor, you don't necessarily want to engage because it's not interesting. In the end, we want to see really unique, emerging categories, people that think really deeply about how to solve a problem, and then it might or might not be a fit in terms of the stage or kind of the vertical, etc. But at least you want to engage. You learn something and you find it interesting because somebody's tackling a problem and is really passionate about tackling that problem in a really smart way. And that would be my biggest advice. Work on something that you're passionate about that is very unique.
I would just say know your audience. It's pretty simple. If you're going to cold email someone, have done the work to understand why they might be interested in what you're doing and tailor your pitch that way. One of the investments we made is actually from a cold pitch that was emailed to us based on a blog post. And that was the reason that we decided to take an initial meeting was not only because they had an interesting idea, but they had done the homework to understand what about their business would resonate with us.
Don't start up with dear sirs.
So it's just a matter of knowing your audience. At least in our case, we respond to every cold email we get. It takes a lot of time and energy and effort, but again, part of why we're doing this is because entrepreneurship is hard, and our job as investors is to help entrepreneurs, whether they're in the portfolio or not. So we try to provide not just a no, but a reason behind the no, or take a meeting, depending on how good a job they've done on convincing us that it's a fit for us.
Is that because you're new and newish and hungry and got to be a little more founder-friendly, founder-responsive? I mean, 2 years from now when the fund has doubled in size and you're still going to be responsive?
Fair question, but I was a partner at Battery Ventures for 4 years, and while the rest of the fund didn't take that approach, I always did, because it's just having been on the other side, how I would appreciate being treated, and we try to be the investors that we'd like to have involved in our companies. So hopefully it will continue and scale. No long-term promises, but it's our intention certainly to continue in the same way we have.
I will say I think Satya and his partner may be the nicest people I've met, so it's a legitimate statement. I also try to respond to every email. I've actually had to hire a team to help make sure we respond to every email. Unfortunately, most of them are things like, wow, I love your product, but no. And I really love entrepreneurs, to a couple of points here, that have done the research, know why they're contacting me and not just are contacting 500 people, and can explain what they do in a very crisp and succinct way. And the hardest thing to do is say no to someone who's so passionate and so engaged in something that we've all been on the other side of. Like, I've fundraised any number of times, and it's a horrible process. And the worst thing in the world for me is when an entrepreneur will not take no for an answer. Because I'm trying to give a very respectful no and like let them get back to work. And so the only thing I tell people is like, I'll give you like as frank an answer as I can. And like, that's the answer. Like, I can't help you, dude. But I see a lot of entrepreneurs who just can't let go, and I feel bad for them.
Good. Yeah, it almost seems like there's a trend these days of investors differentiating by being better at saying no. I feel like I've just been kind of reading this.
Well, to your earlier question, entrepreneurs have many more choices now than they used to, which is a great thing, right? They can turn to platforms like AngelList and many others, and there are many more sources of capital than there ever were, and so it's important, I think, as investors for us to react to changes in the market and differentiate ourselves in whatever ways possible. And unfortunately, the bar has been really low for a long time. So just being able to respond to emails seems like true innovation when it really shouldn't, probably.
If you've been to it, the Benchmark website is my favorite. There is no email, and there's really nothing about them. They're like, please God, don't call us. It may be the worst, most unfriendly website I've ever seen, and I love the guys, but it's a terrible execution.
Cool. Let's one more question, then we'll open it up to the audience. Where do you, it's like an interview question, where do you see yourself in 5 or 10 years? But really, I mean, we see a lot of these seed stage funds kind of grow up, raise larger funds, and become kind of the traditional VC funds they disrupted, X years ago. First round just had a big round, closing right. Do you think this applies to you? And I'll throw it out to anyone who wants to take it. But do you stay small, lean, founder friendly, or does it just natural tendency to get bigger? And then you have guys like Gil kind of chasing you from behind with his syndicates, right? So it's like, I don't know.
Well, we've raised 2 funds in a row the same size, and our next fund we've already said is going to be exactly the same size.
Okay.
And same strategy, same paperwork for our LPs, and so it's just easier for us. So for now, yeah, I think we're staying the same size, but that might change in the future, who knows?
You found your...
But we found our what we love to do, and every day feels like it's not work, and so as long as it feels that way, we'll keep doing it.
Yeah, probably going to stay on the kind of boutique side. So next one might be a little larger. There might be a second partner at some stage, but we think like there's great alignment if you run a small fund that is entrepreneur focused, and you don't have to have a huge operation, kind of $100 million fund. So.
Yeah, and we're a first-time fund, so I think we're smaller than we want to be, but we want to probably be more closer to Ant's size, and that's only because we realize that we need more capital to support the companies over their life. Right now we can support them pretty safely through the B, but we want to be able to do that over an extended period of time, so we need more capital for that. But our goal is also to stay certainly sub-100 million forever, hopefully.
Gil, how big is your syndicate in 5 years from now? Go ahead.
So 3M once did a study where they found that any factory or office that got over 200 people lost unit cohesion, and they ended up limiting the size of every office and every factory to 200 people. So my argument is you don't want a big fund, you want a locust of little funds. And so I'm launching my 3rd fund this week, and my goal 5 years from now is to have 20 funds that do different sectors and do different stages, and they each have a team, and I'm busy recruiting the team, so if anybody were interested. The first fund took 9 months to get to 4 million, the second fund took 30 days to get to 1 million. We'll see how long the 3rd fund takes, but I think AngelList is really incredibly disruptive, and I had someone come up to me today during the conference and offered to introduce me to Middle Eastern families with money. I think crazy shit is going to happen through these syndicates, and my goal is to have as much shelf space in it as I possibly can. Not because I think there's a lot of money in it per se, because I think the disruption is really fun, and I want to cause as much trouble as I can.
That's funny. one last thing on your kind of the rapid growth, well, I guess relative growth of your syndicate. Are you like hustling behind the scenes and just make it look easy, or did you catch the momentum that sort of fed on itself?
Yes and yes.
Yes and yes.
A whole lot of luck and a whole lot of hustle is the only way any entrepreneur becomes successful.
Good. Let's see. Hilda will take the mic around. This gentleman had his hand up right in front of him.
So it seems like there's two big seed philosophies. One, only raise as much money as you need to get to your next milestone. And two, maybe because of the Series A crunch, as it's called, raise as much as you think you can do to delay the Series A as long as possible. Where do you guys fit on that?
I think you can never spend your way into product market fit, right? So from that point of view, yes, you need to have enough runway, and usually we recommend 18 to 24 months. But in beginning to get to product market fit and kind of get an engaged user base and kind of figuring out how to then in the future you can scale it, money doesn't fix that, right? So I think money distracts because you hire too many people, and usually it's much better to have a core team of 4 or 5 people to figure out that product market fit, instead of having 10 or 12 and having perhaps sales guys that sell something that's not yet ready. So I would rather tend to be on the conservative side in terms of raising that money and not get distracted.
What we always tell entrepreneurs that your number one, there's 2 jobs when fundraising. One is to get money in the bank, and 2 is to maintain optionality. And generally that means raising less money than is available, certainly in today's market. But you want to raise enough money to be able to get to a point where you can raise that Series A, and the Series A bar has changed. Right? So I'd say that's why you see seed rounds larger than they used to be. Right? Our average seed round now is probably between $1.5 million and $2 million. And probably even 5 years ago that looked more like 750 to $1 million. But raising 3, 4, 5 million at the seed round is really, really dangerous for a host of reasons. Not the least of which is that people expect you to accomplish more, and you have to do it at a point where you have to justify a much higher valuation, and more money doesn't actually solve that many problems at the very early stage.
I think also one thing I would say is that whatever amount you raise, you'll spend in 18 to 24 months. It's just sort of, I've seen maybe a handful of entrepreneurs who've broken that rule, but whatever you end up raising, you will end up spending in 18 to 24 months.
So I have a bunch of data from a variety of angel friends that tell me that $500,000 is a guaranteed path to failure. It is simply not enough money to get the traction you need to go from the people who invest in hope to the people who invest in data. So that seems to be enough to only get in trouble. I agree with Satya that sort of $1 million, $1.5 million is probably sort of the current norm. If I'm a first-time entrepreneur, my answer is I raise as much goddamn money as I can, because odds are I'm probably going to fail anyway. So I might as well at least have some fun. And if you're me, I helped launch a company about a month ago with a couple of buddies of mine, and my answer was we raise as much money as we possibly can because crazy people are willing to give insane valuations right now. So we did raise a $3 million A. The expectations are ridiculous, and our point is, well, that's kind of half the fun. So I don't think there's a math answer to this. I think it's a very emotional answer, but I think you're norming to sort of 750 to $1.5 million with a whole lot of 2, 3, and occasional $6 million seeds, which are kind of hilariously fun. And, I mean, to some degree, if you can pull it off, you're probably getting a decent valuation, and you might as well take it in this market.
Hi there. While I appreciate emotional decision making, I'm a Stanford mathematician and I like hard numbers. One of the things that concerns me about raising an early seed round is about giving away too much valuation when your company is on sale. And I've seen a lot of different, conversations about different financing strategies, convertible equity from Yokotaku, convertible debt. There was that whole AngelGate thing. What do you guys think? What is the way to do that? How do you get a good deal, get enough money, but not give away too much up front, and also have a fair enough profit turnover for the VC? What do you think entrepreneurs should be doing right now?
I'm not one that, so Floodgate in general does not do convertible notes. And the reason why is that, and I know a lot of angels do, for us, what I found over the last couple of years is that when the note converts, we end up not getting the shares to convert at the price that was promised. And the VCs have just gotten savvy to this. And what they do is they give the original investors common shares as well as preferred shares at the price of the Series A. And so my point is, if I'm going to get a price round, I might as well get the preferred shares that we had already sort of agreed the right price was for. I know that pricing can also be difficult for an entrepreneur, and that's where, a lot of times in my dealings with entrepreneurs, the whole question is whether or not we want to work together. And that's the fundamental question. And if you want to work together, then you can find a price where it's worth it to the two of you. And if you can't, if the fundamental issue is price, then you haven't found the right person to work with. Or you should just go find, angels who will just put money into you, and you don't want someone to work with you. And that's sort of a fundamental question, I think, that every entrepreneur needs to answer.
I worry that people who insist on equity have emotional control issues, because ultimately the economic difference between a cap note and equity is kind of the same thing, but equity comes with veto rights. And my answer...
It's not economically the same. If you don't get preferred shares,
if it converts into preferred shares,
it doesn't. It converts into common shares.
Well, if you write bad notes, you can get in all kinds of trouble.
Ask any of the VCs. When they convert, and I've seen these happen in several of my rounds, it's not, they rewrite the structure and they ask the original investors if they'll change the terms of the note in order to get Sequoia to invest, or one of the top VCs.
And any new VC can cramp down.
You're not going to say no to that. You're going to say, great, you raise your round.
You're right. And I'm gonna say yes to that if I'm a preferred shareholder or I'm a note holder, because I kind of want Sequoia in the deal anyway. It doesn't matter what the structure is. If I'm going to get screwed by a big guy, I'm going to get screwed by a big guy. Like that happens. It does happen. I don't think the structure. I think it does. I didn't get pro rata on LinkedIn in the A, the B, or the C, or the D, because I got screwed out of it, and I had preferred.
That doesn't have to do with your original share.
I had preferred. It did.
Right, but your preferred shares stayed preferred shares.
Yeah. So all I'm saying is, I disagree with the belief that there's an economic issue. I think it's an emotional control issue. Though this is an emotional topic. I'm doing an investment right now where I don't get a board seat, I don't get a veto, I don't get all the shit that everyone else wants. And my answer to the entrepreneur was, great, I just have to invest at a lower price because my ass is kind of hanging out the window here. And I have to trust you, and I'm willing to trust you, but it's going to cost something.
I think in the end, there's three things you can optimize for: quality of the partner, price, or speed of the fundraise, right? You can't optimize for all three. You have to pick which is the most important to you. Some people say, I couldn't care less about the partner, price is all for me. The other guy said, listen, I want to work with the best investors I have the best personal relationship with, and price is only secondary. You just have to decide it. There's no kind of single priority for anybody.
Yeah, it's all about the market clearing price, right? So for you, if you want to minimize dilution, create scarcity. Right? Get as many people interested in what you're doing as possible, and then from that basis, negotiate with your preferred partner and see if you can find a happy middle ground. I think, for better or worse, there are market rates right now, right? If you're raising a seed round, you can expect to be diluted by 15 to 25%. I think that's pretty much the middle of the road for a lot of seed rounds right now.
But it keeps growing.
What keeps growing?
That dilution, the onset, when you're early.
So, as an entrepreneur, you decide, you want to have 0% of 70% of something or 100% of nothing. If you need money to build the business, then you have lots of choices, and you can choose which path you want to go down. Right? Equity crowdfunding and VC are not the only ways of raising capital out there. Right? There are bank loans, SBA loans, friends and family money. There are 100 ways to raise money, and you just got to figure out what that capital is worth to you.
Yeah, but to be fair, it is a treadmill, right? No one's putting a gun in your head and saying you have to take money. You're choosing to go down a path where someone else is holding you accountable for things. The one thing I would say on the dilution front is that VCs, as a favor to you, offer to take pro rata and to contractually obligate you to further dilution down the road so they can make more money. Whereas syndicates don't reserve pro rata, so we're actually incapable of taking advantage of all this dilution we can give you down the road. So it's another way I pitch, one of the advantages of AngelList is those people can't do the pro rata and the B and the C and the D, they just don't have the money. So if you want to minimize dilution, take more money from angels because they literally can't take the dilution down the road.
Therefore, syndicates are not ratcheting.
Not ratcheting.
They won't ratchet. They won't go in. They won't dilute you based on future rounds.
No, so this is more pro rata than a ratchet. Most preferred comes with a ratchet. Convertible debt by definition has a ratchet because if you do a down round, it converts into down round. So again, I go back to whether you have preferred or convertible debt, you're still screwed if you have a down round. You're screwed either way. It's just a question of like whether you're screwed with a veto or screwed without a veto. This is more pro rata, which is they have a right to take more in every future round, whether you like it or not, where we can't necessarily afford to take more as an angel.
Let's squeeze in one more question and then we gotta wrap it up. Paul?
You spend a lot of time with companies who are on the road to product market fit and not at product market fit. As an entrepreneur, how can I realistically assess, am I 25% of the way, am I 75% of the way? Because I'll dilute myself, so how can I check?
I think it's binary. I think product market fit is one of those things that if you're asking if you have it, you don't have it. And so it's not one of these things where you're partially the way there. And what I've seen, at least with the companies that have achieved it, it's just, it turns on and all of a sudden it's magic. And I didn't believe it until I saw it for the first time. And then I understood sort of that's what it looks like in the wild. And for a lot of the companies that I saw achieve that product market fit, it was literally within a week. You could look at the data and you could say, we're there, right? But I've never seen it where it was sort of a very gradual thing. Even in enterprise, it was like, all of a sudden we had our 7-figure PO and we knew we were there.
I think the only exception to that is probably marketplace and platforms where you have a network effect. You might have a product market fit, but just kind of supply and demand flywheel hasn't started yet, and sometimes you go through that tough phase of 2 or 3 years where it's just gradually growing and suddenly it's kind of the inflection point has hit. But that's one of the toughest business models to really stay the course and convince yourself that you have product market fit, and at some stage the flywheel will start.
Yeah, I mean, I think agreeing with Ann, it is like porn, right? You know it when you see it. But the mathematical way of thinking about it, and the way we like to look at it is, you have cohorts of users, and when you see the cohorts flattening out instead of decreasing in terms of their engagement rate, that's when you know you have product market fit. So in a marketplace business, your cohorts might be quarterly because the frequency of transactions less frequent. In a social app, it might be daily or weekly or monthly. But when you see those weekly, monthly, quarterly cohorts flatten out and not decrease in terms of their active, the percentage of users that are active, then that's, from our standpoint, product market fit.
I will say, for all my mouthing off, the 3-year have a lot more courage than I do because they will invest before there's product market fit, and by and large, we try not to. So for me, product market fit in enterprise is 10% monthly growth over several months, and in consumer, it's 20% a month compound growth for several months. If you have that number, I want to talk to you.
In terms of revenue or users or things?
Yes.
Yes.
Like something that matters.
Okay, let's have a big round of applause for these guys.